Well, hey there, everyone. Happy Friday, April 17th, 2026. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. I've got a beautiful day here in Redmond, Washington. Just grabbed a coffee with Mrs. Keller, came back to do the show. Hope you guys are having a great Friday as well. I actually pulled a glute muscle playing in the parents versus kids soccer game with my son's soccer club team. So these markets are literally a pain in my butt. That aside, let's continue on today, recapping yet another strong day for risk assets. We're going to talk about how the S&P up, just over 1% here. We're recording this early afternoon on Friday, so we'll see what happens in the last couple hours of trading, but certainly a lot of strength off of the open, selling off a bit in the afternoon, but for now, definitely achieving a new all-time high for the S&P 500. Dow 50,000 is not too far away, with the Dow up almost 2% here midday, but small caps and mid caps getting into the game. The breadth is fairly strong today. Consumers and industrial sectors are at the top of the list. Pretty good risk on feel. Now, today is Friday, April 17th, which means it's quad witching day, right? This is options expiration. So all the different options and futures contracts expire, which means we often have quite a bit of artificial movement, artificial volume, as I would say, with rebalancing and trading that has to occur because of that expiration date. So I think the real question is going to be what sort of follow through we get next week. This week has been risk on, and I'll show you the evidence to prove it. By the way, we are recording today's session here, our All-Mailbag episode, and we're going to feature some great questions that have come from all of you here over the last week or so. Please keep your great questions coming. Anytime we do the live stream, you can ask questions as we go. If you're watching the replay on our YouTube channel, just use the comments section there on our YouTube page to share questions. I read everything that comes in, and we hand select some of the great questions that we will dig into in a few moments. Just a quick check-in on what things are, how things are happening. We're doing this just after 2 p.m. Eastern on Friday, so we'll see what happens in the last 90 minutes of trading or so. But so far, it's been a pretty constructive day and a nice follow-through to Wednesday's close above 7,000, and I think that's the real story here. Of course, this week is achieving that key threshold, and we had the trumpet fanfare to celebrate that earlier this week. And if you missed that, please enjoy reviewing that show. Let's go through the evidence here really quick. As a reminder, for our market misbehavior premium members, we'll have the weekly flight plan coming over the weekend. That's our most important investment research, where we dig into some of the key themes and focus on positioning and an outlook for the week to come. You can find more info at marketmisbehavior.com/premium. By the way, if you want to be a part of that growing community of like-minded investors, use the code YouTube when you check out, by the way, if you go to that page, for a deal on your first 12 months. So here we got the S&P currently trading just above 71,020. Up just over 1%. So far, it's been the Dow over the NASDAQ, and I think that's been one of the biggest changes, right? Midweek, as the S&P pushing toward and then above 7,000, it was all growth, right? It's sort of the Mag 7, and the breadth was not particularly strong. Here on Friday, we're actually seeing a broader advance with the breadth conditions improving a bit. Mid caps and small caps both working. The equal-weighted S&P having a pretty good day. I don't know if it's actually going to achieve new all-time highs today, but it's very close to doing so. So up until today, we've had the S&P, the cap-weighted S&P breaking out, but the equal-weighted S&P not quite doing that. We might get some sort of confirmation here. Volatility, not surprisingly, remaining in the upper teens, which is still a low volatility environment. That's one of the red flags I would look for, which we are not seeing yet, would be a spike in volatility. We'll see if that plays out. As markets going risk off, we're seeing bonds rally as well, and rates are generally pulling down. The 10-year yield just below 4.25%. The long bond yield now below 4.9%. The 5-year point now below 3.8%. So we're seeing the yield curve generally drift lower here as bond prices go up. The dollar coming down, which is kind of a risk-on move as well for the markets. Looking at the commodity space, crude oil down. Obviously, the news headlines. Really part of this risk on trade today is the Strait of Hormuz essentially reopened, although, again, sort of competing headlines with the U.S. saying we're still kind of blockading things, but Iran saying it's open. At least those are the headlines I read a little earlier. We'll see. That's obviously a very fluid situation. And again, I I still would say we are one bad headline away from the market going right back down. But for now, risk on, as there's optimism of this conflict winding down in some meaningful way. Crude oil prices down quite a bit today. You can see the USO, which is a crude oil ETF, is down about 9% here in the afternoon on Friday. Gold and silver both having a pretty good day, really sort of resuming that uptrend. Cryptocurrency is going up. I actually did add a Bitcoin position here today, given the final confirmation with the break above 75K. I'm a big fan of setting a line in the sand, setting an approach to a chart. In this case, recognizing that break above 75K would initiate, a pretty bullish structure with a breakout above resistance. And it happened, so I did it. As always, we'll use good money management. So if we go risk off, and if the chart goes down, we'll use stops and we'll exit the trade at a slight loss, but worth taking a shot at further appreciation. That's why I put the trade on. So all the top 10 coins tracked on the Stock Charts platform in the green here. So far, pretty good day. And again, a lot can change. And sometimes the last hour of trading can be pretty meaningful in terms of shifts. That's when a lot of institutional activity would happen. But for now, you can see consumer discretionary at the top of the list. The XLY up 2.6%. In the afternoon, the industrial sector, XLI, up 2.2%. Then we get into some defensive sectors, real estate up 1.6%, healthcare up 1.4%. Technology is number 5 on the list. So as you can see, earlier in the week, it was sort of like tech and then everything else. Some of the software names joining the AI stocks going higher. Now it's sort of the other stuff, some of the cyclical stuff, consumer discretionary, which has been lagging a bit. Starting to perform quite well going into the weekends. The relative performance on all the growth sectors starting to tick higher here. Energy, of course, down, not surprising given the weakness in crude oil prices. Again, the conflict in the Middle East causing crude oil prices to spike. The resolution or some sort of ceasefire, some sort of end in sight is causing crude oil prices to come down. As a result, the energy sector coming down as well. Utility sector, the XLU down about 0.5% as well. And communication services flat for the day. I mentioned the breadth here. And one final comment before we get to some of the great questions. Advancers decliner. So the breadth at this point in the day actually looks pretty constructive. And that's, when I think about the breakout above 7,000, as we highlighted earlier this week, like what's not super bullish yet. And I would say, number one, the equal-weighted S&P has not broken out yet. It's very close to doing so. I don't know if that'll happen today, but something we'll be looking for into next week to see if that confirms it. The advanced decline lines, right? The cumulative advanced decline lines not breaking out. The small cap 80 line made a new high, but the other ones had not through Thursday's close. And then, we're just not seeing as many stocks advancing on an average day. We're not seeing enough stocks make new 52-week highs. And I think that's some of the confirmation we're seeing a bit today. And note the small cap breadth remaining quite strong. So certainly a bit of a resurgence in the small cap space, joining the strength that we've seen elsewhere in some of the growth sectors. All right, I'm going to continue on here, taking some of the questions. And again, all of these questions came from viewers like you in the last week, watching the live stream or watching the show on our YouTube channel, just sharing a question. And again, we received some really great questions from you guys. I appreciate them so much. Please keep them coming. It really helps us to think about how we want to shape the content, how we want to approach the markets, and gives us an opportunity to dig a little deeper with some thoughtful questions. So please keep them coming. Here's question number one. I've had a number of questions on Seagate Technologies, right? And Seagate and Western Dig, STX and WDC are two of the storage names in the technology sector. Both of them had really good runs to the upside. Both of them had sort of a consolidation pattern, or with the example, Seagate, we talk about a coil pattern, resolving to the upside here this week and showing further strength. So your question on the entry point. We saw Seagate break out of the coil pattern last week. Then it opened gap up, and that was after that breakout day. And I remember that. Do you enter STX or do you wait for further confirmation to see if this is a new uptrend? That's an awesome question. Let's take a look at the chart here, and then we'll dig into some of the specifics, right? So we're zooming into the last 9 months or so. So just to set the table, we had a really good run into year end. January was actually remarkably strong. And then we talked about this, what we call a coil pattern. And that's when you have, lower highs and higher lows. This is a sign of, it's called a continuation pattern usually, but it's basically a consolidation pattern, right? So some patterns are more generally bullish, some are generally bearish, some are consolidation patterns. They're really more neutral than anything, because of what a coil pattern represents. And again, I always go back to the behavior that causes this chart pattern to emerge. I'm not a big fan of just drawing lines on the chart and saying that they're important. I love thinking about the behavioral reasons why a particular chart pattern should have meaning to us. And so for me, the chart of STX making it, with a narrowing of the range basically tells you the market is in equilibrium. So there are, accumulation phases when buyers are taking control. There's just not a lot of selling pressure. A downtrend would be when sellers are taking control. There's just not a lot of interested buyers. This sideways pattern means there's just a pretty even, market, right? There's plenty of buyers, plenty of sellers, or there's just a generally even amount. So the market's telling you that Seagate's worth about $390 a share, and we're just kind of fluctuating around that level. We can also confirm that neutral pattern by looking at the RSI, right? Look how the RSI is just generally between 40 and 60 as we rotate between the two extremes on the pattern. The RSI just kind of bounces between 40 and 60. So neutral momentum kind of revolving right around 50. So what we look for a resolution to that pattern is a break above the upper boundary with the RSI pushing above 60, or a break below the lower boundary with the RSI breaking below 40. And whichever way that breakout occurs, that implies the new direction of momentum. And that's probably the breakout or the pattern that you want to follow. In the case of Seagate, about a week and a half ago, 2 weeks ago now, we broke above the upper boundary, and then we continued. And so, in your question, you're asking, like, where's the entry point here? So this is where, to be honest with you, I think there are a lot of choices you have to make as a trader, as an investor, right? Where do you actually execute? That is a big part of the reason why when I'm sharing charts like Seagate, you will never hear me say, so you should buy here. So this is the point where you want to take a position. This is the point where you want to do blah. Because I really don't understand your trading approach. I don't understand your risk appetite. I don't understand your time frame. Those are all the questions you need to answer, or with a financial professional, to really understand what makes the most sense for you and your portfolio. We might approach this chart very different ways. What I like to focus on is what the charts are telling us, and sort of give you some ideas and inspiration about how you might want to position yourself around it. So I'm happy to share some ways that different people might approach this, right? A more aggressive way of approaching this chart would be the moment we break out, you take a position. Now, anytime you buy the moment we break out, so in this case, we had a gap that really initiated that. The benefit of that is you're getting in as at the earliest possible time, right? The moment that the breakout occurs, you take the position. The risk with that sort of aggressive trading behavior is you're putting money at risk, and a whipsaw is a very real possibility. And the whipsaw is we open higher, but then trade right back lower. And you've seen that, right? If you've traded more for a couple minutes, you've seen an example of where, like, we go up and it feels like this is the beginning of something, and then it immediately goes back down. You find that all the time with support and resistance levels or patterns, right? Where an initial move is not confirmed and it goes right back. That's called a whipsaw. And so what happens is the positive is, or the benefit is, you get in early. The negative is there's an elevated possibility that it's just a false breakout, and in which case you're caught on the wrong side of it. So you're trading additional risk for the potential for greater return. The more conservative way would be to wait for some sort of confirmation. I always talk about something like a follow-through day. And that idea is something I got from a number of my mentors. John Murphy, whose work I, was sort of, position I followed on in my time at Stock Charts. He would talk about follow-through days and sort of that next level. Larry Williams would talk about sort of the next day and what sort of things happened. Tom DeMark, who I spent a lot of time with earlier in my career, worked a lot with Larry Williams as well. Tom would talk about, very specific rules about we need a higher open the next day. We need to trade at least 1 or 2 ticks higher, like those kind of things. For me, all of my kind of mentors in my formative years of technical analysis all had that concept. The way that you avoid whipsaws is you wait after the breakout. Is it confirmed in the next bar? Is it confirmed in the next day? So for me, that next day, when we close above the previous day's close, when we sort of move to the upside, that validates, okay, we had the breakout, but then we saw further buyers come in, which suggests that is not much of a fluke. it's actually a sign of real accumulation. So how do you do that in your own portfolio or in your own trading? It's really up to you. You may find that you're a more aggressive trader, you're a more conservative trader. Maybe you're somewhere in the middle and you take an initial position on the breakout, you complete the position, right? You put 50% on the initial breakout. If it's confirmed, you add an additional 50%. There's a lot of ways you can play that in your own portfolio, but those are some of the ways you might approach STX. And again, for me, I tend to be a little more conservative because I've just gotten burnt before where you buy a breakout and then it just goes right against you. So waiting for that follow through day, your success rate is a lot higher and you're giving up some of that initial return for a little more peace of mind that the chances of a continuation are much higher. Hope that makes sense. And thanks for asking about Seagate. This has been a great example chart for us to review here for a number of weeks. All right, next question. I have a question as to why I never see that you use a simple moving average over the volume. I would think that would show you when volume is above average and may show institutional buying. It's a very astute observation. I mean, to be honest with you, I don't use a lot of volume, period, in my analysis. But I'm betting you're thinking of this chart because this is the one where I often show volume. This is the, this is a volume chart that I look. This is on the SPY. So we have the SPY, we've got the daily volume bars here, and then we've got the Chaikin money flow. And we talked about this on Wednesday or Thursday's episode, if I remember. So your question is, why don't you put a moving average on the volume, which we could definitely do, right? So volume overlay. Oh boy, I should know how to do this. I don't remember how to do this on stock charts. I am so sorry. Where do I do that? Volume overlay. I think that's it. Do I do it here and say nope? Oh, I know what I got to do, I think. Volume is on this list. Then, there we go. And then I can say moving average. So I'm going to do it this way. I don't know if there's a way to put it in that background. All right, so we'll do like a 20-day volume. So same volume rating. I just kind of added it as a separate indicator. And this is how I think you do it on the stock charts platform to overlay a moving average. It works. This is one way to do it. So your question is, why don't we put a moving average on here? So the short answer is you definitely can. I guess, and so what you're doing here is basically saying this is the 20-day average of the volume. So, we can see when days like this are almost double the average volume because it's way above that blue line, which represents the 20-day moving average. I can see that more recently, it's much lighter volume than it's been over the last month because the bars are a lot lower. The histogram is a lot lower than the moving average. So is a helpful way to do that? For sure, right? You could totally do that. I guess my answer to that would be, I guess visually, I feel like I can already tell that just by looking at the bars. And maybe this is just something from looking at thousands, if not millions of charts over the years. Like you can just see visually, all right, like I can tell that that's way heavier volume than normal. Even here, just because what I usually do is just kind of eyeball the last month. And we have some of the highest volume days. I know that's higher than average. Do I need to know exactly what percentage higher? Like, I don't think I do. I think it's pretty easy for me to visually recognize that this is lighter than average volume and that's heavier than average volume. And if I get rid of the moving average, like I think I still can kind of figure that that's lighter than average and that's heavier than average. So that's the answer, right? I mean, and we didn't have a moving average, and I kind of pointed out, look, this is way lighter volume than we've seen on the S&P, but I'm looking to the left and I'm seeing all of this and I'm seeing where we're at relative to that. If you're just getting started and using the moving average would help you visually just identify that, I think that's a great way to do it. I would also say if you're looking at like a bunch of charts in a row, right? Like if you're looking at your portfolio or like a group of stocks and you're just going one by one kind of quickly to see which charts look interesting, having that moving average just as a visual cue to just help you quickly assess. So instead of like looking and thinking about the volume, you just quick glance, are we above or below that blue moving average? I think that's a great way to do it. So if I did more of those, like if I was going through a list of stocks and thinking about volume as part of that, I probably would put the moving average on there just for a visual cue. But do I feel like I kind of need it, on a normal day? I guess I don't, right? I guess that's why I don't do it. All right. Is the daily market direction largely driven by people or by computers scanning the headlines? Computers which can't take headlines or comments with a grain of salt. Oh man, that is such a great question. That's a thought-provoking one. That's the kind of question personally that at a conference of technical analysts, I would hope in the evenings over a beverage, we would be debating questions like that, which honestly has often happened at some of these conferences. But I love that question. So here's what I would say. So is the daily market reaction largely driven by people? I would say yes. Is it driven by computers scanning the headlines? I would say no. Are computers scanning the headlines serving to add to movements that we see in the markets driven by people? I would say yes. And let me explain. What you have to remember is there certainly are algorithms parsing and with the large language models parsing headlines, particularly in the short term on the daily time frame. You certainly will see that. And to be honest with you, though, that's something that's been happening quite a bit. I would say it's not as much, and I should clarify. I don't think it's as much computers scanning the headlines and running these like AI models to see a headline and take action. I mean, that happens to some degree. Is that the majority of market movement? Does that drive the market? Definitely not, I would say. Most likely not. Are there algorithms and computers that are looking for movements in the markets and then capitalizing on those? Absolutely. And if you look at a lot of like the most successful hedge funds, right? I'm talking like Bridgewater Associates kind of success, or Renaissance Capital kind of thing is what I meant. These huge, they basically built a whole business on capturing short-term movements, just quick movements, and then making a quick, huge bet and then taking it off. And so, does that add to volatility? I would say generally, yes. Does that mean when the market starts moving, you will see algorithms kick in and markets accelerate? Absolutely. For me, I would say on the day trading time frame, that's changed the game over the last 20 years for sure. Undoubtedly, the amount of algorithmic driven trading of all sorts. But I would say it's not really computers scanning the headlines. It's more computers and algorithms picking up on movements and trying to make short-term bets to take advantage of that. There are certainly quantitative approaches that would look for a move and then play the breakout. I would argue that it's probably why breakouts still work really, really well. The fact that there are a lot of humans still very much involved, I think, is very important. The fact that a breakout occurs and then additional algorithms kind of continue that and recognize that strength, I don't think that's a huge deal. I mean, technical analysis by my read still works pretty well. And analyzing and looking for breakouts and inflection points and changes in momentum and trend work as well as they ever have. So I'm not seeing like some issue. And I think that's often a concern people have is, if computers are just scanning headlines, like what's the point anymore? I think it's still in the end is driven by human emotion, and any algorithm you ever hear about, you have to remember what it's designed to do is quantify that human emotion. Without the human emotion, without people getting nervous and getting excited and trading as a result of that, there wouldn't be much for those algorithms to read. So I think that idea is still very much alive and well. But I appreciate that. Over time, as AI gets better, will there be more AI models scanning headlines? I can't imagine that's not true. Will that eliminate the value of technical analysis? I would imagine absolutely not. With that in mind, great segue into our webcast coming up next Wednesday, April 22nd, 1 p.m. Eastern. We'll be giving a presentation called Follow the Leaders, Relative Strength, Breakouts, and Better Ideas. You can sign up for that free event at marketmisbehavior.com/leaders. We will talk about using relative strength to analyze performance relative to peers. We'll talk about breakouts and scanning for names starting to show renewed strength. We'll talk about better ideas and just how to have a consistent process of surfacing opportunities for your portfolio. That's a free event coming up next Wednesday. I hope you'll join me. It'll be a great interactive session. You can sign up at marketmisbehavior.com/leaders. Also want to give a shout out to one of our partners, EPS Momentum. This is a relatively new product. I've enjoyed exploring the platform, have enjoyed working with the creators of the platform, sharing some early feedback as they were beta testing, and I'm thrilled at what they were able to develop, and I would encourage you to check it out as well. EPS Momentum is a platform that captures two things: strong earnings momentum, particularly the change in estimates and estimate revisions, as they're called, and then price momentum, looking at average true range, looking at relative strength, and looking at volume as well. They combine all of those using their quantitative processes with some great screening tools and some great visualizations to give you a one-stop shop to identify stocks showing strong earnings and strong price behavior. You can find more information and learn a lot more about their models and approach at marketmisbehavior.com/EPS. If you use that link, you'll get 30% off a new account, and I hope you'll check them out. Again, marketmisbehavior.com/EPS. All right. I was curious if you could explain what's going on with Avis rental group, right? Car. What I read was short squeezes. That just seems significant. It reminds me of the meme stocks and the froth associated with yours. Yeah, the word frothy has come up quite a bit, but Avis in particular has gone vertical here, right? This is the chart of Avis. I mean, look at the downtrend, August, September, all the way through a February low. Gapped lower, started to rotate higher. That was on Q4 earnings that we gapped down, kind of rotated higher, broke out, and then look at this acceleration that we saw on the chart of Avis. So if I remember right, I don't follow this name super closely, but someone announced taking a significant position or is a big like a buyout or something like that. Pentwater Capital Management. I'm just reading this on Yahoo Finance really quick. I knew something. Pentwater Capital Management disclosed they'd acquired a sizable stake in the company. So that's part of it. Certainly all the congestion around airports over the last, with the government shutdown there, helped to juice Avis. As I'm sure more than one person out there was like, forget it, I'm just going to rent a car and drive. But overall, it's gone vertical. So from a technical perspective, this is what's happened. So anytime you see a huge vertical move like this or a huge gap and it goes sideways, that tells you that there is some sort of capital structure kind of change happening. In the case of Avis, a firm took a huge position and disclosed that as a result. People are feeling like that's a reason they might want to chase that as well. And all of a sudden that drives the price aggressively to the upside. So where are we now? Well, the stock has obviously had an incredible April. It's extremely overbought. I mean, incredibly, extremely overbought with an RSI over 90, which is arguably incredibly rare, unusually rare. The relative performance, of course, then has gone vertical as the stock has gone higher and higher. And this is as all the earnings data that I'm seeing, at least with trailing data, is all negative. So it's sort of a pricing in a lot of optimism. This company is going to turn things around here. So what do you do with a chart like this? I mean, so with a chart that's gone vertical, the problem is you don't really have a lot of good reasonable entry points, right? And a name that starts to spike higher, you have two approaches, right? And you saw, I mean, a lesser degree, but a similar uptrend in like April, May, June, July of last year, right? We kind of pushed higher, and then we kind of kept going and going. What you're looking for is like one of these little tactical pullbacks, right? A pullback to the 21-day EMA is something I often kind of look for, as like a pullback within an uptrend. But if you look at what's happened here more recently, like we haven't even gotten near the 21-day EMA. So what do you do now? I mean, it is very difficult to chase a name like this if you don't already have a position. It's had one down close in the last, 3 weeks? I mean, one day, literally only one day where it's not closed higher in the last 3 weeks. That's the strength of this trend. The moving averages are all spread out. The price is well above it. So this is the kind of chart that honestly, it's now accelerated and it's gone higher. At some point, there's some sort of pullback. I would say a lot of investors will be looking for that pullback and using that as some sort of opportunity to maybe get into a position. So with this sort of approach, you have two choices. Number one, take a position during the rip higher. Recognize that you might be buying the peak, but betting on the fact that it's not the top and that we continue higher. And, honestly, you could have made the argument that it was overextended all the way back here. It was overbought as it was breaking above the 200-day moving average. It's just kind of accelerated higher and higher. If I'm looking around at a bunch of charts right now, what I think of Avis as an actionable trade right now, I would not, because it's already had the run that it's had. It's already had an incredible move. I'd probably move on to some other chart and just look for an opportunity when it pulls back, which should happen at some point, and see if there's an opportunity to buy in some short-term weakness. Avis, and again, what I would also say is anytime you see a chart that makes an accelerated move like that, it means something structurally. It means like an M&A deal, some big buyers disclose, a change in management, something's going on, not just a bunch of people think it's an interesting chart out of nowhere. All right, next question. Broadening top for SPX. They do not happen that often. I was taught very rarely. Also, there's no projected bottom to calculate. From classes at the CME, the Chicago Mercantile Exchange, in the early 1990s. So I got in the industry in 2000. I never knew of courses happening at the CME, but I used to go to Chicago quite a bit on my Bloomberg days to work with, to spend time at the CME and the other exchanges and meet with floor traders. I miss those days. It was a lot of fun, just kind of old school trading mentality with a lot of those guys, which was a lot of fun. And I have heard of those classes at the CME from a number of people. It's not the first time that I've heard of them, but your question was, is there a big broadening top in the S&P 500? Yeah, so now we're kind of breaking out. So yeah, is this a big broadening top? Maybe, right? So a broadening top is a pattern, basically like this is what you're looking at. I'm drawing this crudely, but a broadening top. Think of the coil pattern that we saw in Seagate. That's lower highs and higher lows. This is a widening pattern of higher highs and lower lows. It is pretty unusual because what it means is that the volatility in terms of the month-to-month volatility in this case is increasing. We're making bigger price swings, and usually things are kind of narrowing or they're going directionally. This is one where the direction is inconsistent. Broadening tops, I would argue, usually aren't the most helpful patterns. And the problem is because as the range gets wider, right? I mean, if this broadening top continues, I don't know if I would sell the upper end of that pattern just because we're at the upper end of that pattern. Broadening tops, by definition, are expanding the range. So for me, I've usually felt better served not by thinking of it as a broadening top, but more thinking of trend following and trying to follow the trend higher, right? So instead of saying, all right, we're at the upper end of this broadening top pattern, do we break lower? I would be using moving averages. I would be using like the chandelier exit system as a way of kind of tracking the strength of this move and just looking for signs that the upward leg is over. Because as the pattern continues, the ranges are getting wider, and I think those trends are better to be analyzed as opposed to just thinking of it as a big pattern. Because the other thing is, like, if we sell off and go to the lower end of the pattern, that's 1,000 S&P points from the upper end to the lower end of just this quick pattern that I've emerged. So, just thinking of that as a structure, personally, I found a little less valuable, I would say. So broadening top patterns, yes, they are documented. There are examples of that on the weekly chart. You can kind of see that pattern maybe a little better with the higher highs and the lower lows. For me, is that the best way to describe the price action? Probably not. I think of it more as the resistance that is now broken, as opposed to we're getting to the upper end of the broadening top pattern. If we start selling off aggressively next week, though, you may be a brilliant technical analyst coming back to that CME class from the mid 90s, early 90s on broadening tops. Maybe it's time to bring that back. Great question, though, and thanks for sharing that. All right, final question. You mentioned, to my daughter, who's a musician going into college this fall, and I did play earlier this week to celebrate the S&P going above 7,000. Thanks for the comments on that. Do you think being a musician helps you being a good stock chart analyst? Pattern recognition. Many gifted mathematicians are also gifted musicians, so maybe it's the correlation with chart reading. That's an awesome question, and thanks for that. And I wanted to address this one just because I think it is true. I mean, one of the things that I've enjoyed the most out of my career in the financial industry is talking to people about all the other things that they do outside of the markets and how they help, how those activities and how those fun things that you do, help you be a better investor. For me, music is part of that. Learning to fly an airplane, aviation is part of that. And a number of people whose work I've really enjoyed have been pilots, like Greg Morris, who's one of my mentors and was a career pilot and was a fighter pilot before that. There are a number of investors and technical analysts that I know that are former engineers or pilots. So I would say the two big kind of groups that I see that are very common in the technical analysis community: musicians and creatives, and engineers, pilots, all of those that kind of think logically and with systems. And I think for the engineers and pilots, what attracts them to technical analysis is more of the statistical methodology. The fact that you have a bunch of data, it's like a cockpit and you're looking at all the instruments and you can evaluate the conditions. Greg Morris is one of those. Tom McClellan, it reminds me of that. He was a helicopter pilot and an engineer, and has that way of thinking, a very mathematical way of evaluating market conditions. And I think that's a great training, a great proving ground. Musicians and creatives as well. To your point, there's a big mathematical component to music. And I didn't understand that enough before I went and studied music as an undergrad at Ohio State. And you take music theory courses, and all of a sudden it's a bunch of mathematics. And you're talking about the Fibonacci ratio and the relationships between different tones and why certain things sound good. And there's actually a mathematical reason why an octave makes sense, and why a perfect fifth, if you know music, or those key intervals, why they sound good. There's actually mathematical reasons. It shows you the wave patterns, and it's fascinating. And I really didn't understand that part of music until I studied it more deeply. I would also say, as a musician, my training, I studied trumpet and voice, but what I was planning to do before I got into the financial industry was to be an orchestral conductor. I was studying conducting. I was, working with some of the musical groups at Ohio State toward the end, and doing, different rehearsing, and just thinking about how to get a group of 100 musicians, for example, to, communicate what you saw on an orchestral score. And one of the things you would have to do was you would do a bunch of score study. They called it ahead of time, where you would sit down, either listen to the recording or just look at the piece. And an orchestral score has like 15 parts. It goes by very quickly. And you have to glance down at this piece of music and look for patterns and think about who has the melody, who's playing together, who has, where's their consonance or dissonance, right? When are musical themes moving together or disagreeing with one another? You have to understand music history to think about what period this is. And so you know what probably comes next, because there were best practices during different musical periods as to how you would write different structures and what sort of chords and themes you would use. And so you do all of that visually. So the first time I was in, I went to I was in training at Bloomberg, and someone showed me a chart, and I was looking at a chart with like a bunch of technical indicators on it. It was like score study. Like somehow I felt like, oh my gosh, that music training, that conducting training, this is exactly what I was doing. It's like you glance down and you're looking for patterns. You're looking for what's moving together, what's moving apart. There's a very visual component to it, but then you have to take that visual evidence and then turn it into something else and think about what it means, and look at relationships and think about how that relates to other things that you're seeing or hearing. So somehow it's actually remarkably good training. I would say that's part of it. Pattern recognition is a big part of being a musician. If you're a good sight reader, which I was, mainly because I never practiced, so I always had to sight read stuff, meaning I didn't see music ahead of time and I would just have to read it cold. I ended up being very good at that because I never practiced, to be honest with you. And so that is very much what you do with chart reading. You quickly look visually and look for input. So I would argue that's probably a big reason why there's a good relationship. And it's so funny. There are a number of us in the technical analysis community that have backgrounds in music, that either study music or it's a big part of what we do outside of the markets. And those are the kind of things that make what we do a lot more fun. How boring would life be if we didn't have all this other stuff to talk about? Having said that, that's our show for today. Folks, thanks so much for those awesome questions. Those all came from people like you in the last week. Please keep them coming. If there are any questions that come up during our live stream or as you're reviewing the shows this week, just use our YouTube channel, drop a comment there. We'll be looking for your question and hope to answer it next week. Don't forget our upcoming webcast next Wednesday, the 22nd. You can sign up for that at marketmisbehavior.com/leaders. That'll do it for today. Have a wonderful weekend. Be well, stay safe, enjoy. We'll see you on Monday. And remember, it's always a good time to own good charts. Take care, folks.